Welcome, everyone. So we are going to have now the presidential address, but usually before these things we have a festive occasion because we give awards. I'm Antonio Cabrales. I don't have an award, but I'm going to give one. So the award that we have today is the 2024 Higgs-Steinberger Award. And it's been given to, as you know probably, or if you not, I'll tell you, this is the award for the best paper in the Journal of European Economic Association. And this year it's been given to the private and external costs of Germany's nuclear phase-out. It's actually, I've read it. I read it before it was given. I was not in the committee. The committee was composed from Romain Vassière, who is the managing editor of the journal, Maristella Otticini, past president, and Imran Rasool, who is our future president. So very distinguished, and so I wasn't surprised at all that this paper got the prize because it's very exciting. Let me read you what they wrote. The motivation is this, the authors, Stephen Jarvis, who is with us, Olivier Deschênes, and Akashia Jha, sorry for the pronunciation. This path-breaking paper addresses a central question: what is the proper role of nuclear fission in the context of the transition to low-carbon sources of energy? The authors use the unique setting of the phase-out of German nuclear generation in the wake of the 2011 Fukushima accident to assess the costs and benefits of nuclear fission. The paper convincingly shows that this phase-out was very likely a major policy blunder. On a substantive level, the paper carefully and credibly documents the unintended consequences of the phase-out in terms of increased electricity generation from coal-based plants, as well as imports of electricity. To offset the resulting excess mortality, risk, and cost of a nuclear disaster, to offset the resulting excess mortality from local air pollution, that's the key thing, one would need to greatly overestimate the risk and cost of nuclear disaster or to be implausibly risk-averse. Arguments based on behavioral distortions such as loss aversion, probability weighting, and framing effects resulting from the salience of nuclear accidents, on the other hand, can explain why German voters still tend to favor the phase-out of nuclear energy despite its apparent net costs. On a methodological level, the paper breaks new ground by using machine learning techniques to estimate the sources of electricity generation that substituted for shattered nuclear plants. A deep knowledge of the science behind local pollution, a solid understanding of the process of electricity generation, and a keen grasp of the environmental trade-offs involved in shutting down nuclear plants all underlie the compelling economic analysis displayed in this remarkable contribution. It's really great. And it's a show of the great research that is published in EEA all the time. And we're very, very happy to give the award to Stephen. Thank you, Stephen. Do you want to say a couple of words?
Well, thank you very much, and it was a real pleasure to get this award. We were very pleasantly surprised to get the email, knowing that, to hear that this was coming. So Olivier and Akshay send their apologies that they couldn't be here, but I'm obviously glad that I could. Thanks again to the panel who chose our paper. It was really nice to see, you know, I'm somewhat biased, but seeing energy and environmental research getting a real focus in this sort of thing was really great to see. And the whole process was great. Bart Harstad, who sort of edited the paper, we had some great reviewers, and overall it was a really fantastic process. So thanks very much. It's a pleasure to be here and a pleasure to get the award.
Thank you. And keep sending your best work to EEA, please.
Good evening, everyone. I am Eliana La Ferrara, and as one of the past presidents of the European Economic Association, it is my honor to introduce the current president of the EEA, Professor Ian Eeckhout, who will deliver his presidential address this evening. Ian is the ICREA Research Professor of Economics at UPF in Barcelona. He received his PhD from the LSE, and prior to joining UPF, he was a tenured professor at UPenn and UCL. He was also the Louis Simpson Visiting Professor at Princeton. In addition to being president of the EEA, Ian is a fellow and a member of the Executive Committee of the Econometric Society, a member of Academia Europaea, a research associate of the Institute of Fiscal Studies, a research fellow of CPR and of CORE. And he is an associate editor of JET and of the Review of Economic Dynamics and has been editor of the International Economic Review. I'm not going to continue because the list of Ian's honors and awards is too long for me to go through, but I just want to mention that he has received not one, but 3 ERC grants, which for those of you in Europe who try applying is actually quite an achievement. So Ian is renowned for his groundbreaking research in labor economics, macroeconomics, and industrial organization, particularly for his work on the macroeconomic implications of market power and on the economics of labor markets and of cities. He has an impressive number of publications on these topics in top economic journals. And actually, one of his most influential contribution is the body of research that he's done on the impact of market power on the economy. He has provided critical insights into how increasing market concentration and the rise of superstar firms contribute to wage inequality, economic efficiency, and overall economic growth. His recent book, The Profit Paradox: How Thriving Firms Threaten the Future of Work, presents a compelling narrative on how market power is reshaping the economy, leading to significant implications for policymakers and society at large. In a nutshell, the book describes how, over the past 4 decades, a small number of large corporations have captured the gains from technological progress, acquiring rival firms and creating highly unequal outcomes for workers. Instead of passing on the benefits of technology by lowering prices, these corporations have increased them. And I will not say more on this because I believe that Ian will speak at large on this topic in his presidential address. But I want to mention one other area where Ian has made key contributions within labor economics, and that is the study of matching in labor markets. His research on how workers find jobs and how firms fill vacancies has improved our understanding of unemployment, job search dynamics, and the effects of policy interventions on the labor market. Even though by reading Ian's book, you may marvel at his ability of telling the story of common workers and explaining economic concepts in a very accessible way, Ian's research is characterized by rigorous theoretical foundations. In fact, he's an excellent role model for those among us who strive to combine theory and empirical work on issues of high policy relevance. Ian is also a very reserved person. I tried to get an anecdote about his life as a kid, as a grad student, and I wanted to share it with you, but I had no success. Hence, I'll have to close on this note and ask you to join me in welcoming Ian Eeckhout, who will enlighten us on the value of firms and profits, value and profit of firms. Thank you very much.
Thank you. Thank you, Ileana, for the kind words and the very generous introduction. It's very nice to work together with Ileana because we organized this conference together. The first time I attended this conference, it was back-to-back. So you had to stay for 8 days if you wanted to see some of the papers from the other society. But then we figured out that, our predecessors figured out that, we're all the same people. They're just 2 different societies with the same community of people. And I think it's in my view, a big improvement that we have critical mass. We have more people around at the same time. We have more of the lectures, more invited lectures, more of contributed lectures. And I think it's a great thing to have been able to do this year with Ileana. I really enjoyed it. I also want to thank a number of people who have worked for the European Economic Association. First of all of you for coming to the conference, for presenting, for participating, for making it also a pleasant experience. The profession has had some bad reports in the past, but I think we're working hard to make it a pleasant experience to be part of this community. And I want to thank in particular the members of the program committee. They had a tough job. We got a lot of submissions. They had to read the papers. They had to make difficult decisions, also reject papers, accept papers. And they were under the leadership of our two program chairs, Ghazal Azmat and Ben Gollop. I would like to thank also the people who work behind the scenes. There's a whole year of activities that go on within the European Economic Association. There's things that go on in the Education Committee, Research Committee, the Minorities Committee, the Women in Economics Committee. That goes on for the whole year. And then we see some of that at the conference here in panels and discussions and particular sessions. I would really like to thank those people for putting in the work during the entire year. And then for the organization here, I'm really grateful for the local organizers for opening the university to us under the leadership of Philip Hans Francis, who's put together a team that makes sure that everything runs well. We're at Erasmus University in preparation for this conference. I read the biography of Erasmus. I didn't know anything about him. It's a very interesting person, a Catholic priest who started to criticize the Catholic Church. This gave rise to Protestantism through Luther. He wasn't too happy with the polarization. If you read it today, it looks really like today's politics, what he was involved in. But what I thought was interesting about Erasmus is that he really didn't want to take too much of sides. I mean, even though he was a Catholic and he was kind of promoting the Protestantism, he wanted objective facts and analysis on this debate. It looks like academics. So I think, having Erasmus as a name for your university is perfect, because that's what we do, trying to be objective and use facts to come to conclusions. So I'm very happy for Erasmus Universities for hosting us. And then my last thank is for the people who run the EEA. Without them, there wouldn't be a Congress and there wouldn't be any EEA. And that's our Executive Vice President, Antonio Cabrales, and our Executive Manager, Jamal Pruner-Thomas. Please join me in a round of applause to thank them. Thank you so much. So today I would like to talk about maybe something like a pension fund. If you have a pension fund, maybe you're not actively investing in particular stocks, you just have maybe an index fund, because our colleagues from finance tell us you can't beat the stock market in the long run by active trading. And so the good thing about that is, if you don't look at it too much, maybe once a year when you do your taxes, and you see, a nice return. I get a return on average, what we've seen in the last decades, around 7-8%. At some point, you don't even ask questions about this. It's taken for given. There's some fluctuations, but since you, first of all, have a diversified portfolio, you don't worry about one stock doing better than the other. You just you worry about aggregate fluctuations. And you can have a bit of a bad ride maybe in 2008, where you see a 40-45% drop of your portfolio, but by 2010, it was back to the pre-recession level. So there's not that much uncertainty. And within finance, people have looked quite a bit at explaining why these returns so high, why aren't more people investing, so the equity premium puzzle. I don't want to talk about that today. I want to talk about the other side. Where are these valuations coming from? Where are these firms valued so highly? And I think the first intuitive reaction is, well, a firm is valuable because it's profitable. It generates cash somehow. Okay, and if the firm is profitable, then in the end, we're going to be willing to pay more as an investor for it. And if the firm is profitable, then basically we're trying to think, where do these profits come from? And I want to talk today also about the market power that's behind those profits. And in the past, I've used kind of 3 measures of market power to try and think where market power comes from, or at least how we can measure it. And one is markup, is the price marginal cost ratio. And it's the preferred measure in industrial organization because it tells us really how firms price, how they set prices relative to their competitors. And this tells us the amount of market power they have. And if you have a markup of 20%, it means, well, you sell this object relative to the cost of producing the plastic and the chip that's in here and the labor, and you sell it at 20% higher. If the markup is 50%, you sell it at 50% higher. We also look at profits because profits tell us a little bit more. It tells us also about the fixed cost, the entry cost, maybe the cost of innovation. That tells us more about, barriers to entry possibly. If these fixed costs are higher, you're going to end up with fewer competitors, which is going to affect, of course, your markups. And then you think, okay, maybe the markups are higher because the fixed costs have gone up. And there's some of that in the data, we see that. Think about intangibles. If you look at tech firms, they have enormous intangibles, much higher cost in intangibles, barriers to entry and typically very low marginal costs. That would give rise to high markups, but maybe the rise in the markups is just there to compensate for the fact that these fixed costs are higher. But then you should see profits being flat, and we don't see that either. So we see markups going up, we see fixed costs going up, but we see also profits going up. That's a second measure of the extent to which there is market power, and that informs us about what the situation is in a given market. And then there's a third measure, which is the stock market value of a firm, or in general, what is the distribution of stock market values. And I think it's valuable to look at that because it tells us yet another dimension of the market, and it's more a long-term vision. It's about what is the flow of profits that this firm is going to make in the future, of course, suitably discounted, and it tells us something also about what investors believe about this. So the stock market value tells us something about, the long run in terms of the profitability of the firm. There, not just the level of profits is important, also the persistence. Because if I'm going to have just high profits for one period, this is going to look very different in terms of the value of the firm than if these profits are persistent. And this comes back to the Schumpeterian idea. Schumpeter is saying, you need incentives to innovate in terms of monopoly power, but he really insisted that these incentives are temporary, that they're not permanent. Okay? And so the stock market value is going to inform us about that dimension, if you want. Of course, investors on the stock market understand this because you open any TV channel where they talk about stocks and they talk all the time about the price-earnings ratio, the value of the firm relative to the profits of the firm. Okay, price in their language is the value of the firm, earnings is profits. And if you have a low price-earnings ratio, it looks like it's maybe a good investment, buy some of that stock. If you have a high price-earnings ratio, you maybe want to sell. So investors really look carefully at the reported earnings, the reported profits all the time. So there's not just the relationship between the value and the profits, but then, of course, where do these profits come from? If it was perfectly competitive markets, profits would be zero. So there wouldn't be any reason to have high profits and therefore high stock market valuations. Of course, there's a lot of literature that also talks about it. Here's a quote from a book by Peter Thiel. Peter Thiel is the founder of PayPal and the first external investor in Facebook. So he's a very successful venture capitalist. In his book, 0 to 1, he says, to create and capture lasting value, what you should do is you should look to build a monopoly. And Bruce Greenwald, an academic or colleague of ours in Columbia, you may know him from his work together with Stiglitz on the Pareto inefficiency of markets when there's private information. He has a book oriented towards entrepreneurs and towards MBAs, and he argues, the book is called Competition Demystified, he argues, look for opportunities where there's barriers to entry, because otherwise you won't be able to make profits and you won't have a valuable investment. I have to admit, I've done it once too. I had a student who said, I'm done, I don't want to be an academic anymore. He was doing a 3-year postdoc, he had enough. I tried to publish, I can't get my papers published. My first reaction was try to convince him, stay, this is a wonderful job. He said, no, I want to open a restaurant. Then my second reaction is, maybe you should do something with your skills. You're a good coder, you know how to handle data, maybe you want to do data science. And from looking at the data, if you find a monopoly, a local monopoly somewhere, maybe you can make some money. He says, no, he didn't heed my advice. I think it was a good decision. He opened up a restaurant, he's very happy. He's now opening a second one, so he's very happy, even more happy. But he also wants to come back to academia, by the way. So he came back and he says, I'm going to spend 2 days a week doing research again. He wanted to continue a project we had been working on. I said, that's great. I mean, this looks like, you're entrepreneur, you're self-employed, you can decide how much you work. He says, yes, I've chosen 2 days a week, Saturday and Sunday. So he's back, and so we're going to continue to work on the relationship actually between market power and value. Now, people have understood that relationship between market power, profits, and value, but there's one enormous caveat, and all those who do finance here will probably think it right now. Whenever I mention this, everyone says, Cochrane 2011. Cochrane writes a paper in 2011, extremely influential, a beautiful paper that says there is no relationship between the value of a firm and the dividends. And dividends are what firms pay out of their profits. And so basically we can't see any relationship between the profitability as measured by the dividends and the value of a firm. And the conclusion of Cochrane, therefore, is that, if the value is the discounted stream of dividends, dividends don't tell you anything about the value of a firm. It must all come from variation in the discounting. Okay, and that's an important conclusion there. So, dividends are not the explanation. And what I'm going to try and do today is see what's going on there. Can I, from maybe a macro point of view, add something to it? I should warn you, it's going to be a very simple exercise. There's going to be a model towards the end to try and see what the mechanics are, but it's basically, to a large extent, a measurement exercise. And I want to know what the determinants are of market value. I'm going to focus on using the measure of profits instead of the measure of dividends for these kind of calculation, the relationship between the profitability of the firm and the value. And then I'm going to quantitatively decompose these determinants of the firm value. Once I've done that, I want to answer one question, and I want to answer the question, what is the effect of competition policy on stock market values? And the first thing you're going to ask or want to know is, what is the effect, if you have one, on your pension fund? What's going to happen to my pension fund? If competition policy is going to wipe out profits, how much is that going to wipe out the value of my pension fund? And it's not just for you as a private investor, it's also going to be for institutional investors. I had the honor to give a talk at the Norwegian Central Bank at the research department, and I think it's one floor up or down. They have the people from the Norwegian Sovereign Wealth Fund, and they were at the talks, and I met with them afterwards, and we talked about what is objective, and they say our objective is, well, we have this fund which is between 3 and 5 times GDP. It fluctuates a lot because of oil and gas prices fluctuating. But let's say it's on average 4 times their GDP. So every individual has 4 times the GDP sitting there to be spent sometime in the future. That's why Norway is so rich. And they say we are worried about 2 things. We want to make that grow in addition to the flow of new income coming in from these oil and gas revenues. We also want to make sure that we don't take very risky bets. And they were still a little bit hurt by the experience in 2008, the Great Recession. So they say we look out for the type of decisions we make that are not going to be too risky, that might wipe out the fund. And I say, maybe that one of your biggest risks is going to be policy risk, in particular competition policy risk, because if worldwide in an ideal world there's going to be stringent or more restrictive competition policy intervention, that's going to lower the profits and going to lower the value. And they said, we never thought about that. And they said, how much is it? I said, I don't know. So that's what I'm going to try and answer today and see if I can come up with a number for how big that effect is going to be. It's of course not just about that number, how big that number is. There's also an issue about what is the welfare implication of that. And the first one that we're going to see is that, sure, profits are going to go down, but welfare is going to go up. In fact, output is going to go up. Okay. Why? Because, you reduce the frictions, you reduce the deadweight loss, so you increase the size of the pie. But the slices of the pie are going to look very different. From the smaller pie, the profits were big slices. From the bigger pie, the profits are going to be smaller slices. Why? Because it's going to be in higher wages, general equilibrium effect on wages. It's going to be in lower prices, so therefore higher utility for the consumers. There's going to be effects on entry, new firms entering. There's going to be a whole lot of different distribution effects that we have to take into account. And really, if you think about market power and policies that address market power, these are all policies that are heavily redistributive. Okay, there's winners and losers in there. But of course, competition policy in practice is very different from the type of exercises we can do as saying, you know, let's assume that the market power is the same as it was in the 1980s, which is what I'm going to do. In practice, things don't work like that because technology has changed and you need to deal with that redistribution. There's a lot of lessons to be learned from competition policy in practice. I came to it late. I started working on market power about 8 years ago. I've been invited to some of these policymakers because they want to know some of the macro issues. We have many better I/O people to talk to them about how these markets work, but sometimes on these general equilibrium effects, they want to talk to macroeconomists as well. And I had to learn quite a few lessons. One of the lessons that I had to learn is, you know, how this all work. And so one of the things I often see with friends of mine who are in I/O is that, okay, what about this revolving door? You know, doing some consulting, working for the government, do both sides. Everyone says, yeah, it's an issue, we have to worry about that. It's not necessarily, you know, the cleanest thing, but, you know, Amazon pays $1,500 an hour. I do a bit of consulting on the side. They say, you know, I have kids in school, I have to pay for it. I'm the only one out, never been asked to do the consulting, so that was my first lesson of doing competition policy in practice, that you have to be part of that group. So this is the first kind of description that I want to show you, which is, if we look, suppose you had invested in all the stocks, a representative portfolio of all the stocks that are publicly traded. There's about 5,000, 6,000 toward the end of the period, the number of firms changes. And so you have a balanced portfolio of that. There's different ways of weighing it. We have different versions in the paper, but ultimately the results look very similar. This is the average return that you would get, normalized to 1 in 1980. I'm going to do that in all these graphs. I'm going to have everything adjusted for inflation, so you can think of real returns. So that really broad portfolio had an interesting kind of return. If you had invested $1 in 1957, you would have had $1 in 1980. Instead, if you had invested that $1 in 1980 and you held onto it till today, you would have a return of around 9.38 times that $1. Okay? So basically, you would have an annual return, real return of 5.19. That's kind of that nominal return of 7-8%. So there's a huge difference between what happened before 1980 and what happened after 1980. If we look at markups, markups show a very similar pattern. Before the 1980, there's kind of an inverted U-shaped pattern. From 1980, markups start to increase. If you look at profits, it looks very similar. I'm going to show you in a second. It's not just about averages. There's a lot of heterogeneity in here. If I just show you the top 7 firms in the stock market in 2023, so by market capitalization, they're the tech firms, and now we have NVIDIA in there and we have Tesla in there, they're accounting for over 23%, nearly a quarter of the value of the stock market of these 5,000, 6,000 firms. Okay, so 7 firms are a quarter of that in the stock market valuation. About 13% of profits, but also if you look at the change between December 22 and December 23, the increase of the stock market valuation is just under 50% due to these 7 firms. There's a lot of heterogeneity in the stock market, but it's driven by really the outer tail. And we'll see that. What I'm going to show you is basically this type of figures. On the left figure is what I showed you before, the average, and then the middle and the right figures are about the distribution. The middle is 1980 and 2022 density, and then the right one is the percentiles. And you can see on the right there that these percentiles are driving what's happening to these averages. This makes sense when you think about what market power is, because market power is about, you know, a few firms that dominate, and they're going to be in these percentiles. So if you look at the stock market valuation, it's driven to a large extent by these top firms. You may say this is a US thing. Let's look globally. It's different globally. The rise of the average, we only have data from 1980. This is a sample of firms around the world. It's not full coverage as we have in the United States, so there's maybe issues of selection. But we have an increase of a factor of around 5.5 compared to the 9.38, so it's less of an increase. There's also increased inequality. There's also percentiles, especially at the 90th percentile, but not as much as there is in the US sample. If we break it down by, let's say, continents, we have Europe and the United States looking fairly similar, having an increase over the last 4 decades by a factor of close to 10. North America, which now includes also Canada and Mexico, looks very similar to what we saw for the United States and also for Europe. It's different for Asia and for Oceania, which is basically New Zealand and Australia. So there's differences across the world, but at least not between Europe and the United States for this data. So let me try and think about how we can link market value to profits. You probably know this definition. If you look at the value of a firm and its relationship to dividends, it's basically the discounted stream of dividends written in recursive form is basically the discounting by an interest rate R, the dividend at a period T, and then the continuation value. If we write it out, summing each valuation for each period, we basically have the infinite sum of dividends, suitably discounted. The discount factor beta, which is equal to 1 over the 1 plus the interest, the discount rate rather, is obviously going to have an effect too, because if the interest rate changes, the discount rate changes, you're going to have a change in the valuation. There's something extremely brilliant about this formula, which is that if you look at a firm, everything that goes into a firm must ultimately come out as a dividend. It may be at liquidation of the firm, it may be when the firm gets taken over, but ultimately everything that goes in must come out as a dividend. And that's why this formula is so clean and so beautiful, because you know eventually whatever's in the firm is going to be paid out as a dividend. Maybe as a lump sum at the end, and they never paid out a dividend through the whole life of this firm. So you can think of, if this is a Lucas tree, this is a wood full of trees. If you think about what the stock market is, and at some point a tree is going to fall, you take out the tree. Okay, it may never have had any fruit, but in the end, there's still value to whatever the tree is. Now, there's Cochrane, what I mentioned before, and Cochrane finds a very striking result that there's no relationship between a dividend and the value, and therefore everything must come from the variation in the discount factor. What I would like to do is kind of focus on profits, because dividends are not that great as a measure. The formula is beautiful, but dividends are not that great for the following reason, that in the data you will never see what happens at liquidation of most firms, because they're typically not liquidated yet. So if a lot of the profits stay in the firm, then the dividend is a very bad measure. And so firms, on top of paying dividends, also do other things with their profits. They pay them out as executive compensation or employee compensation, who get stock options. These are not dividends, but they're part of the shares, so you pass on the ownership to another party. There's share buybacks. There's ways in which some of the shares are bought back. Cash leaves the firm and you buy the ownership or the property of the firm back from a shareholder. These are other ways in which you pay out some of the profits. Of course, you could adjust your measure of dividends to include this, but there is something that you can't adjust, which is that there's retained earnings. Firms retain earnings and don't pay them out. And that makes also the measure of dividends much more volatile, because firms make this decision how much to retain in a strategic way. Some of this is because of financing decisions. I want to finance my investments with my existing profits, my own cash, rather than go to bondholders or to banks to find new money. So instead of paying out dividends, I'm going to invest it. So that's a strategic decision. or there may be even signaling reasons why firms do this. And these are all kind of reasons why looking at dividends might be not as ideal as you would like it to be. So instead, I'm going to look at using the market value in relation to the profits. As I said, what investors look at this price-earnings ratio, which is a way to say, well, this is a stream. Profits are also volatile, but at least there's no decision of how much profits there are, because that's what it is, what you see in the books. And so now I'm going to have the fruit of the tree, but I have to be very careful now that there's also something that accumulates in the firm, because there's going to be value that's been accumulating from the past. I'm going to call this shareholder equity E here, that tells us that on top of the discounted stream of all my future profits, I have what I have never paid out that's sitting in the firm. If I didn't pay out for whatever reason, this is going to be part of the value. What I'm going to use for profits, I'm going to use the standard accounting profits with everything in it. Okay, that includes depreciation, that includes taxes, everything is in there. Notice that accounting profits, obviously, as everyone knows, is not the same as economic profits, because especially for the retained earnings, you should really pay the opportunity cost or the shadow cost of the interest to the owner. So that's what you should account for on top if you had also taken into account these economic costs. But of course, to calculate the value is not calculated based on economic profits, it's based on accounting profits, because these are the flows. If you look at profits, these are my three windows again. On the left is the average. There is an increase in profits by a factor of around 3.5. Okay. The distribution of profits widens. I should be very careful. This is, I can't use a log scale with negative profits. This is this inverse cosine transformation. So basically that's why you get kind of this funky way of representing it. But we see better with the percentiles that there's also an increase in the 90th percentile. Okay, so profits have become more dispersed also here. Sometimes you might ask, these are only publicly traded firms. There's recent work by Atkinson, Eeckhout, and Perry, and they look at, aggregate data. There's this measure called free cash flow from the national income and product accounts, which tells you what the profitability of firms economy-wide. It's even bigger than what we see for publicly traded firms. In private equity, or everything included, it increases by a factor of, well, more than 10. Okay? Remember that for the publicly traded firms, this was something of the order of 3.5. So it's actually substantially larger if you include all the firms. Of course, private equity is known to have different returns than publicly traded firms. In general, these returns tend to be higher. Not for everyone. I always use the example of being careful with private equity, which is a story by my hero and has a relationship to Rotterdam. Wait for it. It's Johan Cruyff, the football player, arguably one of the four best players, with Pelé, Maradona, and Messi, I would say. He's number 4, maybe Cristiano Ronaldo, but there's debate about that. And so when Cruyff retired at the age of 31 from Barcelona Football Club, he started to invest in private equity, and he was probably ill-advised. He wasn't the right person to make those investments. He invested in pig farms in Catalonia, lost everything. So he had to play football again a year after his investment. And so at the age of 33, he started to play again, first in the United States. Then he went back to Ajax. He's an Amsterdam guy, was born and bred in Amsterdam, played for Ajax. And then Feyenoord, just around the river, or across the river from here, managed to lure him. It wasn't obvious because the fans were booing him at the beginning. I mean, he was from the competition, but he came here, and in the end, won trophies with Feyenoord. Was a love story of Rotterdam with Cruyff. So basically, he was successful here, thanks to the fact that he wasn't successful with his pig farm. So you have to be careful with private equity. The second piece that we include is going to be shareholder equity. As I said, how are we going to measure it? Think of this as being the book value. What is the value of our assets minus the debt? We're going to have to measure it slightly differently. Why? Because goodwill is an issue. I'd be very happy to talk for hours offline about what exactly we do. It doesn't matter which way you do it because it's small, but I want to be careful on how to do it. And the way you want to think about this kind of in your head as a model is that there's going to be a percentage gamma that the firm keeps in the firm. So percentage gamma of your profits is staying in the firm. And that thing accumulates, right? So, you know, you have some stock that's in the firm, and then each time that you don't pay out all of your profits, that you have retained earnings, that's making that stock grow. And I'm going to call this shareholder equity, and that gamma is going to play a role for what happens to the value of the firm. And here's the distribution again of what this shareholder equity is. Again, has started to increase from the 1980s. Looks like a similar pattern by a factor of 3. Like the profits, by the way, has become somewhat more an equal shift to the right, but not massively. Okay. But you also see that this 90th percentile plays a role there. What do firms do with their profits? Well, here's the distribution over time of what firms do with their profits on average, and it's basically 1, payout as dividends, 2, have other earnings, which is basically share buybacks and paying stock options to employees, and then retained earnings. These are the 3 categories. And so what we see is that dividends are under 50%, they're around 45%. So dividends is just a small share of all the profits that are being paid out. There's this other distribution of profits, but there's also, of course, the retained earnings that are going to play an important role here. Third ingredient is discounting. We have to discount. So let's start first with the risk-free rate, something that we can measure that's common to everyone. And the risk-free rate started to decline in around 1984 from 7% to close to 0%. This is something that's been well documented, this decline in the risk-free rate. If you look at what the spread is, I take the interest rate that all firms pay and I subtract the risk-free rate. The spread, from 1984 is fairly flat, increasing a little bit. It went up quite a bit in the last few years under COVID, but more or less close to just above 0. Okay, we have these ingredients. Now we have to make some assumptions about how people value a firm. And my assumptions are going to be brutally simplistic. Okay? I'm going to have 2 versions of a model. One is where I'm basically going to assume that your expectations, what you believe is going to happen, is your current profits growing at a constant rate forever. Okay, so the growing rate is just basically ensuring that it's like, I'm going to take 2%, it's going to grow at the rate of growth of the economy. The second version is that I have something closer to rational expectation. I'm going to allow you, as the econometrician, I see the observation of your profits, and I'm going to assume that you knew exactly what that realization is going to be. But I have to take a window because, of course, if I take infinite, I don't have infinite data. If I take the longest window, then I only have 1 period observation, so I have to have something that I can move around over my period. I could take 5 years, I could take 10 years, I could take 3 years. And then what is my discount factor? It's basically the product of the risk-free discount factor and the subjective discount factor. And what I'm going to do now is I have data on all the rest except for the subjective discount factor. I'm going to back that out. I'm going to back out a discount factor for each firm. I'm going to calculate an average. And when I do that, under this simplest set of expectation, what I see is that there's obviously a distribution, but the average is fairly flat but highly fluctuating. Very cyclical, this backed out discount factor. The distribution hasn't changed much. And the only difference between model A and model B is the level. This is model A, around 90% subjective discount factor. For model B, it's 93, 94%. Okay. The model B, there's a bit more of a change in the distribution, but overall, the level difference doesn't look different in terms of the pattern. Okay, in terms of these changes over time. What I want to do next is I want to do the decomposition that I talked about in the beginning. On the left-hand side, I have these averages that I have shown you for each of the components. And on the right-hand side, I'm going to do a counterfactual. What I'm going to take is I'm going to take the formula this simple formula of what the value is, and I'm just going to keep everything constant except one variable, profits, or the discount factor, or this shareholder equity. And that's the lines that are there below. And these are the counterfactual valuations. What would have happened if only one of these components had changed? Of course, they're not going to add up to the full value because these are nonlinear. But what I'm going to do is I'm going to take that as an approximation. I'm going to ask what is the contribution of each of these counterfactual valuations. And this is what I have here. I'm asking what is the change since 1984. I take 1984 because I cannot deal with this non-moneticity and the risk-free rate. And what I see is that the discounting is accounting in the beginning for around 50%, but towards the end for about 20%. This equity, shareholder equity, is around 40%, and the profits, the future profits, are around 40%. So these are these counterfactuals that I've calculated. It looks remarkably similar for Model B. Why? Because it's about changes, and the level doesn't matter. It's all driven, by the way, by the risk-free rate, what the discounting is. Okay. So over this period from 1984 to today, I see that basically towards the end, 20% is discounting, because we know that the discount the risk-free discount factor has gone up, because the risk-free rate has gone down, and that 80% is profits. Some of it is past profits that's been accumulating in the firm, and some of it is future profits that I have in expectation in the value of the firm. Okay, what can we do in terms of a model to think about this? What I would like to do is I would like to make the link with what's going on in terms of the market power of the firms. Because what I've done so far is I only used the profits, but I didn't have any explanation for where these profits were coming from. So why a model in the first place? Here's a quote by one of the pioneers in cancer research in the 1930s, who was a researcher who was trying to find the right chemicals to do chemotherapy. And he said, you know, sometimes we don't know what the effect is of some of these chemicals on an individual, but we have a model of the body, how it reacts to particular chemicals, and we've seen data, and we kind of use that to, you know, try out new chemicals. And he says, a model is a lie because it's completely not true what we have, but it tells us something about the truth because it's extremely simplifying, but yet informative. Okay. And I think what I'm going to do is, you know, you're going to see there's a bunch of lies here, but I hope that it can elucidate us a little bit about the truth. The reason why I have many more lies than what I would have in a model with kind of in an I/O context is because I want to really model the entire macroeconomy with general equilibrium effects. When you're going to see the preferences, you're going to say, this is a lie. Okay. So what I want to know is really what happens when I change market structure, when I change the technology distribution, when I change fixed costs. This is what I really would like to find out. And then I want to perform counterfactuals to see when I make those changes, what is this going to have for an effect on the value of firms through the market power, on the profits, on the value of firms. And then we would like to obtain information where policy can be relevant, where policy can have bite or not. So it's going to be an infinite horizon model. My demand system is going to build on Atkinson-Bernstein, which is basically a demand system that is with a double nested CS structure. I can think of small markets with a finite number of firms and many of these small markets. Why is this interesting, or why does this help us? Well, the nice thing about Atkinson-Bernstein is that I can talk about market power, oligopoly within each market, and yet have general equilibrium effects because I have many of these different markets. And the way Atkinson-Bernstein do it is they say there's a CES kind of trade-off, if you want, elasticity of substitution between closed substitutes. This elasticity of substitution that you see there is eta. And that, you know, if I think of a market, say soft drinks, Coke and Pepsi and Dr. Pepper, they're closed substitutes. They're much closer substitutes than, say, soft drinks and cars and furniture. And that elasticity of substitution between these different markets is going to be theta, and that theta is going to be lower than the eta, which is more substitutable. So we aggregate these consumption indices, and the household cares about ultimately consuming all these goods, about the final consumption. There's this utility of labor because they're going to supply labor, and their budget constraint is going to be, well, it's a static model. The total amount of consumption, the value of the consumption must be equal to what you earn, plus I give all the households a representative portfolio of the stock market. So on the household side, there's no heterogeneity. You get the portfolio. It's like your pension fund. Then firms produce one good. They have a linear technology. So there's basically, a finite number of goods being produced within each of these small markets. There's many of these markets, so we have a continuum of goods. There's TFP technology that tells us how more productive firms are compared to each other. To match the distribution of sales, I also have different productivities across markets. If I'm in sales, that means that, firms are large, they have large employment. If I'm in biotech, firms are small. But there's also the heterogeneity within the market. So, firms compete within the market, but they are kind of different across a market. And there's an AR1 process that how the productivity within a market evolves. If you think about the heterogeneity within a market, they could not compete. What is important for competition within the market in terms of the heterogeneity is that think of a duopoly with two identical firms. They would have equal market share, equal profits, equal markups. Now let there be a mean preserving spread, and I have a more productive firm and a less productive firm. The more productive firm is going to have higher profits, higher market share, and higher markups. In fact, it could be that if the productivity difference is so big that the more productive firm has 99.9% of the market, it behaves like a monopolist. Its price is going to be close to the monopoly price. So you can have a monopoly even if I have a duopoly, or I can have a monopoly, maybe Amazon and 50 competitors who are way less productive, that it can still behave like a monopolist. And that's why this distribution of productivities matters for also what the markups are and crucially what the distribution of markups are. The last thing that I haven't mentioned here is that I'm going to change the market structure, and this is another lie in the sense of making a really brutally simplifying assumption. I'm going to change the market structure to kind of a common ownership assumption, the share that all firms, same share across markets, own in other firms of their competitors. You can think of this as a special case of, well, having mergers or having collusion. Okay, and this allows me to change the extent to which there is more collusion or more common ownership. And I'm going to try and understand what this alpha, this share of common ownership really does in this world. Solution, the demand side is standard. I take that from Atkinson Bernstein. On the production side, well, you just choose how much to produce, taking into account the competitors within your market, so you could know competing. This gives us a first-order condition that looks, well, like the Lerner formula. It's a price times 1 plus the residual demand elasticity. It now depends on the residual demand within your competitors, sorry, your own residual demand and that of your competitors. But we know that from Lerner that 1 plus the elasticity is equal to the inverse of the markup. So you can see that price times inverse markup times the productivity is equal to the marginal cost, in this case, the wage, because there's only one input. And we know from the CES structure we can express what that elasticity is in a very simple way. It depends only on two parameters, what these two elasticities are within the market and between the market. There's, of course, also the market share, which is an endogenous outcome, and that's determined by the distribution of productivities. Okay, the market share S that you see there in the definition of the markup is determined endogenously through the fixed point of these Cournot competing firms. The key parameters are going to be how much common ownership there is, what is this extent to which there's competition driven by the market structure, alpha, the dispersion in productivities, which is going to give us dispersion in markups and profits, the fixed costs, and then these two parameters that measure the heterogeneity across markets. It's basically the mean and the standard deviation of this log normal distribution. Here's a simulation. What I'm doing is I'm simulating this economy, and I'm trying to see how an effect of increasing the common ownership, okay, what kind of an effect this is going to have on the key parameters or outcomes in the model. And let's start with profits. What you see in the top left corner is that as I let this alpha go from no common ownership at all, I have as much competition as possible. My profits are normalized to 1. I see that if I go to 50% common ownership, my profits go up to over 1.6. It's more than 60% increase in profits. There's a slightly increase in the dispersion of profits, but not so much because all profits go up. And then the third panel at the top tells us what happens to efficiency really. Welfare and output, they decrease, and this is because there's deadweight loss. This deadweight loss leads to a reduction in welfare and a reduction in output. There's less that's being produced because prices are going to be higher. There's also an even bigger reduction in wages, which comes from the fact that the demand for labor has gone down. Less is being produced at higher prices, and therefore less demand for labor. With an inelastic labor supply, this is going to lead to a decline in wages. Now, the households, to one extent, they don't mind having lower wages because they get higher profits, right? They all have this pension fund. And so they get compensated to some extent, but not fully. And the reason why they're not fully compensated is because, well, the pie has shrunk. Total output has gone down. So their income, wages plus profits is lower under more competition than it is under less competition. And then I take this simulated economy and now can calculate what the market value is. And this is on the bottom left panel. I see under this model A and B that I showed you earlier in terms of what the investors believe, there isn't a huge difference. You can see that, of course, as this extent of common ownership that affects the market structure, as this increases, profits increase, and therefore we're going to see an increase also in the market value under both of these models, as well as an increase in the dispersion. That's what the bottom right two figures show us. The next simulation is something very similar, but I change different parameters at the same time. The only reason why I flash this up is I want to show that the different parameters have different kind of effects. For example, the increase in the dispersion of the productivities gives us a fanning out of the profits. Okay, and therefore you see in the top middle figure that these profits now have a behavior very similar to what we see in the data. This already indicates this is going to be when we estimate the model, that's going to have an important role. Also, I wanted to show that I can have increasing output and increasing welfare because I can increase the productivity over time. So I produce more. I would have produced even more if I didn't have that much market power, if the alpha hadn't gone up that much. But I can even have, with market power, increasing productivity. Of course, you see that there's a wedge between the wages and output that's increasing. So these are kind of the features of the model. I'm going to show you one last thing, which is key. Remember, what was this gamma? This gamma is the share of the profits that the firms keep inside the firm, the retained earnings. Okay? And of course, this is now in exactly the same model. Over time, which was the last version of the model, when I change this gamma, when I have gamma starting at 0, there's no shareholder equity in the firm. You don't accumulate cash in the firm, and then your market value is going to be lower than if you would have 20% of the shareholder equity that's being accumulated, or if you had 50%, you would have market values that are even higher. Amazon, when it went public for, I think, 15 years, didn't pay out any dividends. I don't know whether they do now. So part of its valuation is just the amount of money that they've accumulated in the firm. They've, of course, invested it. But the shareholders at some point want to cash in on that. And we can see that here, that it's important how much is being retained and how much is being paid out by the firms. So last thing, for the last few minutes, I want to show you the quantitative exercise. Quantitative exercise is basically trying to, take that model to the data. These are the parameters that I talked about, again, it's a very simple model in the IO sense because we're trying to capture the aggregate effect, the macro effect of all the firms in the economy. That's why we have this very simplistic demand structure with many little markets that have only two elasticities of substitution within market and between market. So I'm going to estimate this model year by year, matching some of these moments that are moments about profits and markups. Okay. And then I calculate the market value based on the realized profits, taking into account that shareholder equity is accumulating at this rate gamma. I said gamma equal to 20%, which is the average that we see in the data. Gamma fluctuates over time, but I've taken here a constant over the entire period. Here are the three key parameters. The parameters about the distribution don't change much, so I didn't put it up here. In order to match the data, what we see is we need really a market structure to change in a sense that the degree of common ownership, or think of it as there's more collusion if you prefer collusion, or if you prefer that there's more mergers, going from a factor of around 0 to around 20%. Okay, so that tells us that we have less competition even for the same number of firms. Okay, and common ownership is a parameter that captures this. The second result, or the second parameter estimated over time, is this variance, or the standard deviation rather, of the productivity within these firms, and that's gone up. It's gone up by a factor of 4, around going from roughly 0.02 to 0.08. Telling us, again, this story that you have more dispersion in productivities, you're going to see more dispersion also in markups as a result of that. Because the more different these productivities are, the more different the markups are going to be, and you're going to get basically more dispersion in the markup distribution. And we see the fixed costs go up, initially kind of quite high, then leveling off a little bit, but we see also that there's kind of capturing this notion that maybe intangible capital has become more important and that there's a bigger role for these fixed costs. With that, the last thing I'm going to do is do some counterfactuals. I'm just going to ask what would have happened in this economy if, this alpha, this common ownership, was set at the level of 1980. What would happen to today's economy? And what we see is we see a large negative effect on stock market values. Why? Because as this common ownership decreases, there's going to be less market power, there's going to be less profits, and this is going to be reflected immediately in the stock market valuations. What happens if we reduce the fixed costs? Well, if you reduce the fixed cost, the firms don't have to pay up that cost. This is good for value. Okay, so these intangibles were costly for the firms, are costly today. If we take the 1980s level of fixed cost, we would see a reduction in the fixed cost would lead to an increase in the valuation. And finally, we also see a negative effect from reducing the dispersion. It's smaller than the effects of both the fixed costs and the extent to which there is competition. So this is really driving the dispersion, but not really the value very much. Okay, it has a big effect on dispersion, but not so much on the average value. All right, let me take stock of what I've shown you so far. So we've seen in the data that the aggregate stock market value in real terms has grown by about 5.2% since 1980, but before it was 0%, so there's been a change. It coincides with the growth of markups, it coincides with the growth also of profits. That starts in 1980. But there's a huge increase in dispersion. We cannot just talk about averages here because for most firms, below the median, there's either no change or a decline, whereas it's all coming really from the top 90th percentiles where the biggest change are. Dividends, as we measure them, directly, are accounting on average for about 45% only of the profits. So a lot of other things happens with the profits. Some of this is paid out in different ways, like share buybacks and compensation for employees. Some of it is going to be retained earnings. 20% of the profits on average over time across firms stays within the firm. So, of course, if profits go up, for whatever reason, because there's maybe more market power, this shareholder equity is going to go up if they use that rule of 20%. Of course, there's heterogeneity across firms. And so in terms of the decomposition, if you look at the discount factor, and it's mainly the risk-free discount factor, that accounts for 20% of the value, okay, in my decomposition. Profits is accounting for 80%. But profits, I have past profits, okay, which is 40%, and I have future expected profits, which is another 40%. So the good thing is that if I now ask what is the policy risk, if I wanted to answer the people from the Norwegian Sovereign Wealth Fund, I would say if you have this ideal policy that we go back to 1980s levels of competition, then you would have basically a reduction in your stock market valuation by about 40%. Dow Jones is around 40,000 now, it would be 24,000. But that's the ideal policy. It's very unlikely that this is going to happen. Maybe we should do it if Lina Khan starts to sell her stocks. Then we should really worry about it. But as long as she keeps her pension fund, we maybe shouldn't worry about it. The silver lining is that even though profits account for 80%, because these accumulated past earnings are part of what the valuation of the stock is, we can basically, we don't have to see an 80% reduction in the stock market valuation. It would have 80% if we started from 1980 with that competition policy and we wouldn't have accumulated it. But if we do it now, a big chunk of 40%, in fact, of the stock market value is coming from these past profits that are accumulated. I'm going to do one last thing and I'm done, which is, okay, we can use, I think, stocks to talk about what the value of a firm is and how it affects or how it's related. I meant to say how it's related to the extent of competition and market power. There's a lot of issues with distribution. The distribution of surplus, if you think about competition policy, it has efficiency implication, the pie increases, but we really have to worry about what this is going to have for an implication in terms of the slices of the pie. Yes, there's the Norwegian Wealth Fund, but there's also everyone who has a pension fund. Are you willing to vote for more competition policy if this is going to mean a reduction of 40% in your pension fund? Hopefully you can sell before, but if you can't sell before, this is what would happen. So efficiency and redistributions are key. We have the first and the second welfare tier being affected here by this competition policy. Let me come back to Peter Thiel. He wrote later on an article saying competition is for losers. This was an op-ed in the Wall Street Journal. Of course, people now call them the broligarchs, the tech bros who are also oligarchs. They have a strong incentive to not have regulation for the competition. What is the optimal thing to do? I think we need, first of all, an independent regulator. It's probably best that the regulator decides what the intervention is and not the people who have the funds. And second, I think we need rigorous academic research. There's a bunch of IO economists who work on this, but everything I hear from the people in regulation, they say there's basically not enough people. We're up against, the armies of lawyers and economists from the sector, and we don't have enough people to really go against and argue all these cases one by one for more competitive markets. So I think rigorous academic research, it sounds a bit like Erasmus, right? You try and stay independent, you try not to take a very strong position between Catholicism and the Reformation. So I think as academics, that's our main job. Thank you very much.
Get them all together and then
In your decomposition, it seemed like you're assuming there'd be no impact on productivity growth if you if you put into place your ideal competition policy. Is that, you think that's a legitimate assumption, and do you really think that there'd be no consequences whatsoever?
It's true that both in the model and the decomposition, I take productivity as exogenous. It would be fascinating to think about it. I don't have it in the model, and it might, of course, change the findings. What I know, it's a hard problem. So putting it especially in the model, but also in the decomposition, because, you know, we have to take a stance on what exactly would happen. It's something that I think about, but unfortunately I don't have a good answer, and therefore I, you know, don't want to do something ad hoc. I mean, I've got plenty of lies. I would have more if I would do that. But I think it's a valid point.
Thanks for thought-provoking talk. I have a question about these big tech companies, because basically the rise of value is partly because they manage to create and monetize an externality, i.e. network effect, which is completely absent from the analysis. Do you think to what degree that kind of contributes to the rise of aggregate profits, especially at the upper tail?
I mean, network effects would be picked up by increasing returns, right? And so, right, if I think about setting up a platform and I can think of network effects, even though it's on the demand side, as a form of increasing returns. And the only increasing returns in the model I have is through the fixed cost. Okay, so the fixed cost creates basically a form of increasing returns. Why is there not one firm? Because of this, the demand system that says I want a little bit of all the goods. So basically I want to substitute between the different goods. So if I would like to properly put in network effects, I would put it on the demand system. Okay, and it's going to capture something what is now picked up by this fixed cost. Okay, because the fixed cost is giving me a similar kind of increasing returns. This would be very interesting to do. It's a similar answer to the other answer that I gave. You know, I think it's very hard to do in a model, and if you have ideas about it, I would love to talk about it, because I think it's a large chunk, especially for tech, where these kind of natural monopolies are originating, which is these scale economies that come from the demand side. I've put them all on the supply side, in the sense on the production side. But yes, I mean, there's more than that. Again, the attempt here is to build a macro model that captures the entire economy. And that, you know, I have a linear technology. I mean, who believes that? I don't even in capital and labor. I haven't told you what I do to the data to, you know, convert the data with capital and materials to a model in value added. So there's a lot of things going on, you know, underneath the hood that are extremely simplifying, and you know, kind of issues like those would be very enlightening, but you know, doing it is complicated.
One last question.
A related question, I wonder what you have in mind for competition policy. If monopoly is just a matter of increasing market share and making the demand curve steeper, then the competition policy seems clear. You split up the firm. If these monopolies are coming from network effects, then there are productivity gains from having these firms be large. And now splitting them up seems maybe not such a good idea. So our old competition policy may be out of date. We may have to think about something like regulating them as natural monopolies, or something you'll know much better than I.
Well, no, I mean, you know, I've only gone through lesson 1 for the practical policy, but in our opening panel, we had, you know, the person, Inge Bernards, who was the one who wrote the Digital Markets Act, which is an attempt to exactly address that question. So first of all, let me say, in my model, I cannot distinguish between the two. So you know, that's where I can also not say more. But what they're trying to do is they say, if we have these network externalities, or if we like the scale because there's a natural monopoly, we have to try and think of alternative policies like interoperability. So, you know, the simplest example is you have railways. It doesn't make sense to compete with 2 parallel railways. Let's try and have independent, you know, firms who run the tracks and then firms who are on the rail. That's in interoperability. If you think about,